Okay, hello everybody, and after almost 2 years time, we are here for our a Q4 actually update with Curtis. Hello, Curtis.
Hi guys.
Sonny Mulder. Hello, Sonny.
Hey guys.
Sonny is growing on popularity on social networks. When I compare that 2 years ago, I believe he had like 700 followers or so, and today he's in thousands, and we've just been discussing that it's hard to believe it's been almost 2 years.
Yeah, that's crazy.
Yeah, it's been 2 years since we did our last video as a
And,
group.
and there I
Yeah,
have
it's
even
insane.
a screenshot of that on the screen.
We still look as handsome, so we did well.
What was the S&P back then?
I don't know, five something K.
And everyone thought that was super high.
And today people think it's super high, by the way.
Yeah.
6,830.
And 2 years ago, what was it?
Few years ago, so tell you exactly, it was the start of 2024 when we were doing that, and it was below 5,000, Curtis. 4.8.
Yeah.
We were just breaking the previous all-time highs.
And we were debating whether we're going higher.
We were actually agreeing we were going higher there.
Yeah.
We were agreeing on that. And Bitcoin is today, at the very moment of the recording, 105,000. The last time we did this, Bitcoin was 44,000.
Wow.
Sonny, do you have any questions for Curtis?
Yeah, I have to say a couple of things I want to discuss with you guys here. I think it would be really interesting to talk about the Fed dual mandate first. They have the mandate to keep inflation in check, and they have to watch at employment and unemployment. And I really agree. If we look at inflation, it has been trending lower, and I reported that also because I follow the true inflation data a lot more than the traditional reported CPI, because I just think it's more accurate. And we have seen a strong downtrend, well below 2% actually, on that data point itself on true inflation. Then we tick back up, but the question now remains, is inflation an issue or not? And I really agree with Curtis. He mentions that, inflation is not a problem, and 40 or 50% of the basket is like shelter, which is finally rolling over. And it was rolling over already for quite a while. It has almost a 2-year lag, 18 months or so. But then there is a portion in the shelter component of the CPI where we see that big move down. And that's basically where we are waiting to see what kind of influence does that have on inflation or other metrics going up because of tariffs or whatever, while that component is moving lower or not. And I do agree that it's rolling over and it's accelerating to the downside. So is inflation a problem right here? I agree, it's probably not. And I think also Dave agrees to that, or am I mistaken?
No, I think this actually is pretty good inflation, but one thing to point out is that I keep hearing people talking about dual mandate, and that's wrong. That's factually wrong. The Fed has triple mandate. It's to promote employment, then the stable prices and moderate long-term interest rates. It's actually a triple mandate.
Anyways, yeah, I think we're all on the same page
Anyway,
there.
I agree that the inflation at 3% is actually it's a reasonable level. It's a good level to be at.
Yeah, so for me personally, I also see inflation not being a problem. I actually think it's really in a good range. And people often say, or like Powell says, we want to get inflation back to 2%. But actually, if you look it up, the mandate says the Fed manages inflation in a band of 2 to 3%. We are well in that band. We're still in that band. And I really believe mandate achieved, job well done. What I think is concerning is that we are seeing some more weakness in the employment markets. We have just seen some big layoffs from certain companies. But we also see the data I shared with you, the non-farm data. Yeah, in the non-farm employment, while it's not officially reported right now because of the government shutdown, there are other metrics which are recording it. And we see a clear downtrend. And that's really concerning to me. because that's an indication of big weakness. And I see globally, I will talk about that later on, I see more indications of weakness once more. And yeah, that is something I think we need to watch, because it could mean that the employment market is weakening in the fourth quarter of the year, and that could have its effects in the first quarter of next year, let's say. Now, the flip side is that unemployment is historically low, and we're sitting at like 4. So we are still like historically low, and even if we go up, let's say 1%, it doesn't imply we could be in a recession. But if you do look at like many metrics, which I track in my customized recession indicator, we are seeing more reasons for concern popping up in the fourth quarter. I'm not saying recession, because I said that last year as well, and we did not see a recession. What we saw instead was a 20% correction on the SPX, so I was wrong in calling for a potential recession. But now I'm seeing the same kind of deterioration at the end of the year, with an even worse unemployment situation right now. So I wanted to know, how do you guys look at that? Is that concerning to you? Are you agreeing this is something that could be a very big headwind for the markets, or not at all?
One reason that unemployment may be lower is because of the border control increases for the last year. So Trump literally threw out many people, and obviously stopped the flow of new people coming in. The other thing is, yes, so I agree, like in Canada, in Toronto, in Ontario, the province, they're seeing real estate prices fall, and some of the analysis is it's because people are losing their jobs. So they are seeing some mortgage defaults, and the reason is because people are losing their jobs. The unemployment rate is important, but if it doesn't start affecting real estate, as an example, it may just stop there. Oh, I had a question actually, Sonny. Your recession predictor, this is looking forward 6 to 9 months? Like, is this trying to say it's coming?
So basically what I do is I track the most confident data points that I can, which are a good predictor of certain trends. And if you combine various metrics into one number, so I have a total of 12 metrics, they give you a percentage odds of something occurring
in the future,
which I call the recession indicator. And so the higher the percentage is, the higher the chance is that we are moving into a recession, or already are in a recession, based on those data points. We have like the yield spreads, the yield rates, the Fed funds rates, and everything you see on the chart itself. So we clearly saw that since on the right side, since the start of 24, the odds of recession went up over 50% actually in the end, to like a high of 58%. And I was arguing we can see a big chance of recession at that time. We had that discussion together as well. What we did see in the next quarter, so we saw rollover into the next quarter, and we did see a big sizable correction after that. So what I'm seeing right now is basically the same kind of signal building. It's only at 50%, so I'm not calling recession right here. So let me put that straight. I'm not calling that we roll over in a recession right now, but I am calling that I'm concerned, because even though we may not move into recession, we are sitting at like all-time high prices. For the SPX, I predicted 7K. We are at 150 basis points from that, so we're pretty close. And those are like profit take levels. If you combine that, the same with the breadth, breadth on equities is low right now, which indicates there's like a frothy market state right now, and people may be taking profit because of the high prices. It doesn't matter. My concern is that if we have some headwinds, it could trigger another sell-off, sizable sell-off at the very least, because I do not have enough reasons right here to call a recession because of the things that we discussed already, and I agree with many of the points you put out. But I am concerned because of the elevated levels, because of the PEs, because of the weakness in employment, and because of leading indicators, the LAE, and so many other metrics pointing towards something potentially ahead, that people may react to that. And I don't know if you guys agree, but that is a headwind that I'm concerned about. And I'm looking at employment and a clear trend of being one of those indicators that may scare people into a bigger sell-off. What do you guys think? Is that valid or not?
How big of a sell-off do you have in mind?
I predict at least the same as we have seen in 2024. So there is, as you go towards the secular peak, we're still in a bull market. I think everyone agrees. In a bull market, when you get closer to the end, and I expect this bull market to end around the 2030s, roughly set. No one can predict that, but that's roughly. As you get to the end, prices get steeper, volatility increases. And I think we see more sell-offs, which are steeper as well, but also bigger turns up. And we are clearly in what Felix Zulauf also mentions is like a crack up boom, where we see increased volatility, prices going down, soaring markets. And I expect we could see another sell-off of 20% in 2026. When exactly, I do not know, but that is something I'm watching because cyclicals, many different cyclicals all point to that year being a cyclical pivot.
Another buzzword is the K-shaped economy, right? The rich are getting richer, but people are losing their jobs and suffering, and that they're saying, well, why is consumer spending still so strong if everyone's saying, look, we've got inflation is horrible, I lost my job, houses are too expensive, credit card problems, all of this data that's negative, why isn't that affecting the corporate profits? And it's not. We just had, like I said, we had 4% GDP and 8% growth in company profits. So companies are becoming richer. The asset owners are getting richer. Meanwhile, we have unemployment and average people suffering. And can that continue or not? If there's job cuts, but the job cuts are coming from Apple, who's actually now making more money because they have fewer staff, but sales are increasing, profitability increases. It doesn't decrease as long as the consumer keeps buying, right? So that actually corporate profits could rise while unemployment rises, which sounds counterintuitive. The last 2 years have been great for corporations, and that the job cuts, it depends on who's losing their job. If Apple's cutting one of their very expensive engineers, that's increased profits. The average worker is getting hurt and may lose his job, but asset prices may not fall. In fact, they could go higher, even higher. So we could have both be true. We could have a recession theoretically, or let's call it a tough job market, and you could still have corporate profits increase. Also, the PE. So a friend of ours, Mark, who was talking about being worried about very high PE levels. I agree with him that historically, I think we're at one of the highest recent levels of PE. It's at 28 or something. The counter argument to that is, well, we're comparing apples and oranges because let's go back to 1990. Okay, which companies were in the S&P in 1990? I've mentioned this before, maybe a food company or an oil company, but that company was not the same as Apple, which has way better margins, or Salesforce, way better margins. NVIDIA, I think NVIDIA has what, 80% margins on their chips or something ridiculous. Like Palantir has these massive margins, like software notoriously has extremely high profit margins. So it's very hard to compare the profitability of Mag 7 versus like Philip Morris in 1985.
I think that's valid, but I also looked at earnings. Like as long as earnings stay healthy, then that's a, let's say, a tailwind for markets and the economy. Because we have the wealth effect going on for people as well, which means as stock prices are going up, people have more money, so that actually boosts the economy. Yeah. But I also I've checked out an interview, and there they clearly showed in some data points that whenever earnings do peak, within I think 3 to 5 days, actually stock prices move as well, which basically means that if earnings peak and you see downfall, you cannot use earnings that well to make a prediction because they fall with price. So that is concerning as well, because as soon as earnings disappoint, likely prices will go down within a week. So you can't really use that as a trading signal, let's say. I also
Yeah.
looked at like the earnings itself. We have 85% reported with 7% surprise, by the way.
Plus seven.
7.1, yeah, not plus
They
8 to
beat
7.
they beat
Yeah.
expectations by 7%. That's quite a
Yeah,
bit.
yeah. So it's still healthy, but if we exclude the top 10 out of the SPX, as I said, the bread is really poor right now. If we exclude the top 10, then we're actually sitting at a minus 7%, which means they are not beating estimations. So most of the companies are actually a little bit weaker. So that puts out the argument once more, like the Mac 7, right? Mac 7 is pulling everything up. Nvidia is a huge part of the SPX, which is often occurring near market peaks. Now, as I said as well, and as you can see on the picture on top, it's hard to spot a top with valuations because in the 90s, people thought the same. People were calling bubble and prices continued to soar. And for many, many years. So people who were sellers and calling for a bear market, they missed out an X2, X3, X4, X5 even, depending on when they were bearish. So it's dangerous to be short the markets, specifically because of inflation and just like asset prices being driven up with deficit spending and whatever.
Yeah.
But it is also concerning that we see the same dynamics. So I think that it's something we need to watch because it's hard to predict when something will hit the fan. But I'm seeing the same kind of dynamics. Concentration of the Nvidia in the SPX is very high, and we see that near market stops, and eventually those things unwind. So I do think we are getting near an end, but that end could still be 4 years from now. I have to add to that, to the rest of the conversation. Maybe Dave wants to drop his opinion as well, but I remain bullish as well. I said Q4 will be bullish. I remain with the same outlook. I think crypto has more room to move up. I also think equities has more room to move up because we didn't hit my 7K target. I do see a lot of risk, but not enough right now for me to be bearish. And as we see on the screen right now as well, very often we see seasonality in favor and we see market peaks at the end of the year, not at the start of a year. So very often December ends up being a very good year. More than 50% we see positive returns.
That's crazy.
I think we still have some upside left. So my 7K SPX target, which I have been shouting for months, is close to be met once more. I'm fearful for a big correction. Let's call it above 10% up to 20% next year, but I'm still exposed to the bull side. I'm still bullish right now in equities, and I'm not that much, by the way, but I'm still bullish, and I'm very bullish as well talking about crypto. And that's something I also want to talk about. Like, assume that Q4 remains flat. That's a base case Dave made, by the way. He assumed Q4 to be flat and sometimes having a bottom around November, and he was right, I think. Do we assume Q4 is the end of the cycle for crypto?
I just want to show you overview of the data I've brought. So when it will be my turn to talk a little bit in the detail about my data, this is the overview. I basically split it into bullish arguments and bearish arguments, and then I have these lines that have different width. Some are thin, some are fat. And when you have fatter line, then I consider that argument to be stronger. And just by looking at this is the bullish argument, this is bearish. I didn't find that many bearish arguments. And this is all of this data. These are concerning, some of them are about the end of Q4, but most of them are about 2026, Q1 2026, or even further, 2026. So as you can see, by the looks of it, I have many more bullish arguments for this time period, and I will be walking you through them. But those bearish that I have, even though there are fewer, they are generally, I think, pretty decent. So it's also like they have some weight for sure.
Basically, in what you already presented, Curtis, I'm very aligned with. So I do have concerns, but not enough for me to flip bearish right here. And I just wanted to debate mostly what you guys think we can expect for the end of the year and starting next year in the first quarter. I think that's really interesting for people, considering like crypto, if the cycle will continue or not, and what do we see at the start in the rollover period. I think that's most valuable for people, like what's coming ahead.
Right. Yeah. And so obviously the stronger it is in December, the less bullish I am Q1 of next year and vice versa. That's sort of a basic idea, but it seems to me that yeah, we're going to get a bit of a move up here. What does that mean in the first quarter? Well, you'd probably have some sort of sell-off because people just want to take profits. It has been a long bull run. Hey, it's been 3 years. There's not everyone has done well in that period, but there's a lot of profits sitting there. And if you're a fund manager, you don't make your commissions until you sell. And so it's natural you would have a sell-off. And we haven't. Look at the S&P. It's been straight up since April. I mean,
And keep
let's
in
go
mind,
back to let's look at the S&P,
sorry,
Dave.
Yeah, I'm
Yeah.
going.
But look at that. Since April, it's been straight up.
No correction since
Not
April.
really. 1%, 2%, I think was the most.
No,
We had
no
2%.
correction. Correction, we can talk correction from 5% at the very least. But generally, correction by the default, the terminology correction is used for 10%, basically, and more than
Well,
10.
so it was 3,500 in what, October 2022. And so we're exactly 3 years. It's doubled in exactly 3 years. That's a big move. That's a big move.
It
Now,
hasn't
then
done.
you have to say, well, which stocks, right? Because some stocks haven't. But if you're in Mag 7 or that, you're up a lot, right? Anything that's so that chart says that you need some correction. But I think it's going to be profit taking. I don't think it's going to be because we have a recession.
keep in mind also that the SPX has 4-year cycles as well. And that basically means that next year is the 4th year. Also, many cyclicals, which I shared in video on my channel, like 4 or 5 different cycles point towards 2026 being a peak. Also, I think the real estate cycle does.
I'm going to talk about all.
And generally, that points to what you say. Like we didn't really see a lot of pullback yet, so markets can continue up strongly, like 7.5K perhaps. And then we can see easily a 10% correction, which isn't that abnormal because, as you said, we just doubled in the last 3 years. So even if we see another like 20% correction, we still remain in a bull market, which is still really strong, which is probably still going up because of the fiscal deficit spending and fiscal dominance we are in, etc., which is also showing in GDP, which is really strong as well. So it wouldn't be that abnormal if you ask me. And I'm really counting on 2026 to see, another one of those events at the very least, at least 10% easy.
Right. But in a recession, like again, the word recession, Sonny, a true recession where you had negative GDP growth for 2 quarters, that would be a bear market for everything.
Yeah. But I didn't say recession, I say correction. Correction.
Yeah.
The reason we perhaps haven't or aren't going to see a recession is because we are in fiscal dominance and we see continuous deficit spending being added to the economy, which in various ways, as I shown in many videos, like trickles into the economy, providing support. So we are seeing certain areas doing poorly, like manufacturing, while others keep up and are doing really well. So that could be why we are seeing different dynamics, and that's also why I believe GDP is so strong right now as well, which is another indication. Like a very strong GDP is also driven by those deficit spending.
Well, what's the joke? They say a recession is when someone you know loses their job. And a depression is when you lose your job, right?
I would love to start also responding, and I'm gonna do it using my data that I brought. Before we do it, let's refresh, let's have a couple of minutes break. So I'll talk to you in a few minutes, guys.